Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. This man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. And there's the disclaimer.
Excellent.
Let me share my screen. Let me just get on the pre-market here. While I'm sharing my screen, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into the live chat on YouTube. Will's watching it. He'll read them back to me. And to give you guys a couple minutes to type in those questions, we're going to start out taking a look at the pre-market report to see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions. So let's start out with the pre-market report. And over here, up top, we have a calendar view. This does allow you to go back in time to look at a particular historical date if you want to see what happened in the pre-market hours. And here we kind of list the last week to see if we can spot any trends. Today we're on January 25th. And so far in the pre-market hours, this is what's happening. We have 553 stocks traded higher in the pre-market, 247 stocks lower. As far as volume goes, we have 237 million shares trading on up volume, 89 million shares trading on down volume. If we convert that volume to dollar value, we have $3.9 billion worth of stock trading higher, $2.4 billion worth of stock trading lower. So just looking at that, it indicates that trading in a pre-market hours is leaning towards the bullish side. Let's take a look at it from a couple more perspectives, then we'll move on to those questions. I'm going to scroll down to the middle of the page, and here we see a list of stocks that are trading in the pre-market hours. We see the prices and price changes, volume, market cap. And we have the most active stocks, our biggest percentage gainers, biggest percentage decliners. We got 115 stocks that made our biggest percentage gainers list, 51 on our decliners. So from that perspective, it also points to a bullish bias or bullish sentiment in a pre-market. But to make this list, we do set thresholds for liquidity, volume, price changes, because things in a pre-market tend to trade with less liquidity, sometimes very low volume. And to make this list, it can be any security that meets that thresholds. It could be an ETF, it could be an inverse ETF, a leverage product, a closed-end fund. So to narrow down to a smaller group of stocks, we could use the filters here above. If you have a watch list, you can filter by your watch list. So this will filter stocks that are trading in the pre-market hours that you saved in your watch list. We're going to use this filter here in ETF. In our example, I'm going to click on it. So you get a drop-down menu to select from. We're going to pick the SPY ETF. When we click on it, the list below will get filtered by stocks that are holdings in SPY, which are the S&P 500 constituents. And here we have 26 stocks that made our biggest percentage gainers list, met our thresholds, 14 on our largest decliners list. And that also from this perspective, indicates that the trading in a pre-market hours has a lean towards the bullish side. So there's the, we gave it a couple minutes. Will, if we have questions, I'll take the questions.
Nothing's popped up yet, D.
Okay. So let's then default to, I guess let's go to SPY while we don't have questions. It's my default symbol. And let's take a look at this options activity report. I'm just going to kind of come back to it. Just thinking in the back of my mind, some questions that I get either over the emails or chat. And this gives us a summary from a high level of the options volume in this case SPY. If you go to a different symbol, give you a different symbol. So let's just go over some of the data and what type of insights we could grab from there. And here we get a breakdown by how the volume traded. So we see that single leg options, in other words, these orders were not entered in as part of a spread or contingent. It was just a regular call or put order. Those represented 81% of the volume. Okay. The multi-leg trades, which are entered in as, a spread, something that has to more than one leg, two or more legs, that has to get filled simultaneously. It's part of a strategy. That represented 19% of all the volume in SPY. And then there was a small percent which was contingent, which means it usually that there's a stock component to the trade, like a buy rate. And if we break that down further from the single legs, we could see that 49% were calls, 51% puts. So that's pretty evenly split. When we look at multi-leg trades, so these were spread trades, 37% of them involved call options, 63% of those were puts. And if we looked at the contingent, 39% of the options were calls, 61% puts. So, that's interesting. Could have been a put spread that also involved a hedge with the stock. I don't know for sure, but you could see here that it wasn't just all calls and puts with contingent. So, when I think contingent, a lot of times it's buy rates, but it doesn't have to be. And most of the trades, 98.6% of the trades in SPY were executed electronically. So most trades nowadays, that's how you log into your broker, you enter an order through your platform, your portal, and that order goes out electronically. But a small percentage were floor trades. Well, floor trades involved, those are trades, 131,000 contracts yesterday, involved actual humans interacting, negotiating the trades through a floor trader, right? So those are usually done through phone calls and trying to find liquidity and put up a trade with a specialist or across, but those involve more human contact, human touch, negotiating, right? And in SPY, it's probably not surprising most will be electronic. There's a lot of trading going on in there, that's coming from brokerage firms. So let's come down now and see what else we could, what kind of insights we could get. So this here starts breaking it down. Here we have from the high level, then we have a breakdown here by option expiration. So you could see here SPY as I scroll down. This is January 24th, January 25th, January 26th. You could see it has a lot of expirations, right? Going all the way out to December 18th, 2026. But, I'm just eyeballing, I don't know how many, but it looks like there's probably more than 20 on this page, maybe 20 different expirations. So now that we have these expirations, we kind of take each one of them and produce some summary stats. So this way, in this table, we could, quickly reference them and even compare them, versus other expirations. So here, with this event here, we'll list any type of, event that could be material to options, and if we spot it, we'll give an indicator which expiration it covers. Okay, so over here you see this little D stand if you hover over dividends. So we're seeing here that that there's going to be an ex dividend date, and it's going to cover that March 15th expiration. Okay, so that becomes an important date, especially for option pricing or exercising your calls if you need to. But SPY is an ETF. If it was this a security, like a single stock, it could have an earnings or company event coming out here. Let me just see, like in something like Apple. So you could see Apple earnings February 1st. So the February 2nd expiration will cover that event. Okay. So let's go back to SPY. But just to show you guys, that's what these events are, because those are the ones that are important and could be material to the option pricing. Let's go back to SPY. So what is this next column? This looks at the money implied volatility. Now, of course, the expiration has many different strikes, and it has different calls and puts. But to just reference some kind of somehow we have to benchmark where we think implied volatility is in this expiration. So we standardize it to at the money. Okay, so we look at, well, what is the at the money implied volatility? We have a weighted average calculation based on the strikes around it, calls and puts and stuff. So we calculate that at the money IV. And then we could, by doing that, now we could just visually see as we go. So these expirations right now, they're organized by time. So the nearest, is at the top. And then as you scroll down, you go to the one with the longest maturity, longest dated, right? So it goes from shortest dated to longest dated. And what we could now just visualize is the term structure of the implied volatility, that the money implied volatility in SPY. So what do we notice here is that, so January 24th, that's already expired, so we're taking that out. That's the last snapshot, but let's take that out. That's no longer, we're in January 25th today. So that was from yesterday. So starting from January 25th, what we notice is that as we go out further in time, the structure, the term structure, the implied volatility is sloping up, right? You could see here, we're starting 9.8, and as we go out further in time, implied volatility is increasing, takes a little dip here, starts coming back up, but you could see that going all the way out to even here, starts from 9.8 up to 17.5. So the takeaway there is that the implied volatility in the near term, the shorter dated options are priced lower because most likely there's more certainty with shorter term dated options than longer term, right? So right now in the short term, the market feels more confident about the pricing and the volatility and the uncertainty than they do about the long term. Okay, so why in the short term? Well, we have a lot of data and information with earnings, and we know what the Fed may do. They're giving us indication about the next month, 2 months, 3 months. So there's companies, when they report earnings, they give us a little bit of guidance or clarity about how their business is doing currently and in the short term or even in the next quarter. So the markets right now are signaling that we're more comfortable with the stock market is more comfortable with what's going on right now or in the short term or next month or whatever than going out further in time where there's just less clarity, right? We don't know, going out to December 18th, 2026, right? It's really far away. There's less clarity. Many more things could happen that's unexpected. So that's how we could view the current term structure, right? Which is usually the case. That becomes inverted in special situations, but usually this, I would say, is the case more often than not. That's how the SPY S&P 500 term structure will slope, as you go out further in time. The implied volatility reflecting the uncertainty will slope higher. Okay. The next column is showing us the change of the implied volatility using the previous day's closing values. Okay, the last snapshot of the previous day. So just like a stock, when we look at the change, right, we have to identify, well, change from what point? What are we referencing? Is it from a year ago, 2 years ago? Was it in the middle of yesterday? So from day to day, the change usually looks at the previous day's close, right? And so where did it end up at the end of the day? What was your last snapshot in versus options, on the stock? What was the last trade? And that's the change we're referencing, right? So in the middle of the day, when we look at this change, it's saying relative to previous days closing values. So yesterday we see that actually the implied volatility increased across the board. So as I'm scrolling down, it's showing that the entire term structure, it wasn't in one particular expiration. It wasn't in just the front months, not including the back months, there was a general increase in the implied volatility across the board, right? Going from the shortest dated all the way out to December 18th, 2026, which means that that entire term structure lifted. Okay, it increased from the previous day. All right. Now, keep in mind that when we look at a 14% increase in IV, let's say in January 25th, that does not equate to a higher increase, than 2.5% in December 18th, because the vega of these options are different. So a 14% increase in a IV in an option that expires in one day, could be very little, because the vega of that option is, could be a penny. It's about to expire, right? So there's not a lot of it could be a penny. But a 2% increase in an option that expires, December 18th, 2026, that could be $2, $3, because the vega is different. Those options, you're comparing it. You could be comparing a 50-cent option to an option that's $50. So keep that in mind, right? 2.5% here is not the same thing as 14% there, right? In dollar terms, in dollar premium terms. Okay, think of it kind of like a 10% increase in a stock that's 20 cents, right? In dollar terms, it's not the same thing as a 1% increase in $1,000 stock. So just keep that in mind. These are the way implied volatility and vegas work, right? But the takeaway is that entire term structure shifted higher, right? We're just visualizing it, right? All greens here. So what else can we get from this table? What other insights? Well, one of the things we know is that when we look at the implied volatility, right, these implied vols, they're not the same for every strike. It's not like a straight skew. It's not like, if we start out at 9.8, for example, that I'm hovering over, that doesn't mean that every strike has a 9.8 implied volatility, because some options could have a 12 IV. Some could have a 8 implied volatility. The implied volatility is not the same. So we see that there's a skew in the term structure as we go out further in time, but there's also skew in the vertical, right? Go by strike. Well, it's impossible to list every strike here. It would be too much. So what we do is we start benchmarking and saying, okay, if we use 9.8, in this example, 9.8 volatility, and we assumed that every strike has to have a 9.8 volatility, right? Find me a 25 delta put and ask me, well, how is the actual implied volatility compared to 9.8? So this one is saying that the actual one is 1% higher. And if we looked at the 25 delta call, went up and found the 25 delta call and said, well, what's the actual implied volatility versus 9.8? We see it's 1% below that. So then we could kind of now get a sense, a benchmark of what the skew looks like in that expiration. So here, as we go out further in time, let's go out here, So what does this mean? February 29th, 2024, that the monies are 11 vol. So if we took 11 implied volatility and said, okay, run it through every strike, every strike available, and then find me the 25 delta put. Well, the 25 delta put is higher than 11, right? This is what it's saying. It's higher than 11. And, whatever it is, it's 11 and a half, 11.8. Well, how much higher is it? It's 8.3% higher. So, take 11, add 8.3%, of whatever 11 is, that's where it is. Well, what about the call? Is it 8.3 higher to the upside as well? Well, to the upside, it's different, right? To the upside, the implied volatility is lower than 11. If we found a 25 delta call, it's 7.2% below 11. So what is that telling us? That the skew, as the strikes are decreasing, implied volatility is increasing. And as the strikes from the at the money are increasing, as you're going higher, implied volatility is decreasing. Meaning that the market itself is saying if the stocks drift higher, if SPY drifts higher, they're expecting the implied volatility or the volatility of the stock to slow down. It's not going to accelerate. It's going to move orderly. Okay, it's not going to move at a fast pace. That as it's climbing, it will climb at a slower pace, and that volatility will come in. However, if the market feels if we go the other way and the market is starting to go down, then it's expecting the implied volatility to increase because it will be less liquid on the way down. It's going to experience more volatility if we're going down. So that's why there's a skew, and this is telling you how much of a skew. And we could compare that also, so the skew, not surprisingly, over here you could see that it's different and sometimes vastly different. And it probably will tend, at least in the SPY, to widen out as we go out further and further in time. Again, more and more uncertainty, right? So that's what the skew is indicating here. Well, we're right up at 9:30, so I could continue on this tomorrow.
All right, perfect, D. That's great.
Yep.
Awesome job, my friend.
All right, everyone. Look, thanks for joining. Stay safe out there. Have a great trading day. And we hope to see you guys tomorrow.